Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, May 28th, 2026, and we're seeing some significant market movements driven by escalating geopolitical tensions in the Middle East. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant story driving markets today is the sharp escalation in Middle East tensions. Iran targeted a US airbase following fresh American strikes, and this has sent oil prices surging 2.5% higher as energy markets price in supply disruption risks. We're seeing classic risk-off behaviour across asset classes, with safe haven flows intensifying and volatility picking up across the board. Beyond geopolitics, we're getting a mixed picture from corporate earnings that's creating some interesting sector rotations. Snowflake absolutely rocketed 36% higher on a strong earnings beat, and news of a $6 billion spending plan, with Amazon's cloud services, which is reinforcing the cloud infrastructure growth narrative. Best Buy also beat expectations on both revenue and earnings, showing some resilience in consumer electronics despite broader concerns about spending. However, Build A Bear Workshop presented a more complicated picture, beating earnings by $0.7 but missing on revenue, which suggests consumers are being selective about discretionary purchases.
That's a significant divergence in consumer behavior. What does this mean for traders and investors navigating these crosscurrents?
The key takeaway is that selectivity is becoming critical in this environment. The geopolitical premium is getting priced into energy and defence sectors. So we're seeing money rotate into those areas as hedges. For traders, the oil spike creates opportunities in energy equities and related derivatives, but you need to manage risk carefully because these geopolitical situations can reverse quickly. On the corporate side, the Snowflake surge highlights that companies with strong cloud partnerships and AI exposure are still commanding premium valuations, even in a more cautious market. The consumer picture is more nuanced. Best Buy's beat suggests that established retailers with value propositions are holding up, but Build A Bear's revenue miss indicates that purely discretionary, experience-based spending is under pressure. From a positioning standpoint, I'd be looking at defensive sectors and quality names with pricing power rather than chasing momentum in more speculative areas. The market is rewarding execution and tangible growth stories while punishing companies that can't deliver on the top line.
Let's talk about the broader indices. How are you reading the technical picture for the major markets?
Looking at the technicals, the S&P 100 is showing some concerning signs of distribution as we approach key resistance levels. We're seeing volume patterns that suggest institutional players are using strength to reduce exposure rather than add to positions, which is typical when geopolitical uncertainty rises. The index is hovering near a critical support zone, and if we break below that on heavy volume, we could see an acceleration to the downside. The Nasdaq is particularly vulnerable given its heavy tech weighting and the growing debate about semiconductor valuations. There's increasing chatter about whether the chip rally, which has now reached $5.7 trillion in market cap, represents a sustainable supercycle or a bubble waiting to deflate. The technical setup shows the Nasdaq testing its 50-day moving average, and a failure to hold that level could trigger algorithmic selling programs. The Dow is actually showing relative strength compared to the other indices, which makes sense given its value tilt and exposure to industrials and traditional blue chips that benefit from the current rotation. It's holding above key support levels better than the growth-heavy indices, but it's not immune to broader market weakness if risk-off sentiment intensifies further.
That defensive rotation is certainly notable. Are there specific levels traders should be watching?
Absolutely, for the S&P 100. The critical level is around the 2,850 area, which has acted as both support and resistance multiple times this year. A clean break below that on volume would likely trigger stop losses and could lead to a test of the 2,800 psychological level. On the Nasdaq, watch the 18,500 level closely. That's where the 50-day moving average is sitting, and it's also a previous breakout point that could now act as support. If that fails, the next meaningful support doesn't come in until around 18,000, which would represent about a 3% decline from current levels. The Dow's key level is 42,000, which has been a solid floor for the past several weeks. As long as that holds, the relative strength story remains intact. What's important for traders is to watch how these levels interact with volume. A test of support on light volume can hold, but if we see heavy selling pressure at these levels, that's your signal that the character of the market is changing and more defensive positioning is warranted.
Now, let's shift our focus to cryptocurrencies. Lizzie, what are the latest trends you're seeing in the crypto markets?
The crypto market is under significant pressure right now, and Bitcoin is showing bearish to neutral characteristics heading into next week. We saw $935 million in liquidations as Bitcoin dipped to $72,600, and the more concerning development is BlackRock's Bitcoin ETF experiencing its second largest daily outflow on record at $528 million. That's institutional money heading for the exits, and we're also seeing increased miner inflows to exchanges, which typically signals selling pressure. Bitcoin is struggling to maintain the $70,000 support level, and with over $622 billion in options expiring soon, we could see heightened volatility. The combination of geopolitical uncertainty, ETF outflows, and technical weakness suggests Bitcoin could test the $68,000 to $72,000 range next week, with a real risk of breaking below $70,000 if selling pressure continues. Ethereum is looking even weaker, trading below the critical 2,000 psychological level despite futures open interest, hitting a record high of 16 million ETH. That divergence between falling prices and rising open interest is dangerous because it suggests over-leveraged positions that are vulnerable to liquidation cascades. There's potential for a $2 billion short squeeze if buyers emerge around the $2,000 level, but the path of least resistance appears to be lower. With $1,900 as the next major support target, Solana is showing relative strength by comparison, mainly because there aren't as many specific negative catalysts hitting that ecosystem. I'd expect Sol to trade in a $130 or $50 feather range, potentially outperforming Bitcoin and Ethereum on a relative basis, but it's still going to be pressured by the broader crypto market weakness.
What's your read on institutional versus retail positioning in Bitcoin right now?
The institutional picture is clearly deteriorating, and that's the bigger concern for Bitcoin's near-term prospects. The BlackRock ETF outflows are significant because these products were supposed to be the bridge for traditional finance to enter crypto in a regulated, accessible way. When you see $500 million leave in a single day, that tells you institutional risk managers are reducing exposure, likely due to the combination of geopolitical uncertainty and concerns about crypto's correlation with risk assets. Institutions tend to move in herds, so one large outflow often precedes others as portfolio managers reassess their allocations. On the retail side, we're seeing classic capitulation behavior with the liquidations. Over $1 billion in leverage positions got wiped out, which means retail traders who were using high leverage got caught on the wrong side. However, retail sentiment can turn quickly, and we've seen in the past that retail buyers often step in at perceived discount levels. The challenge is that without institutional support through ETF inflows and corporate treasury purchases, retail buying alone typically isn't enough to sustain a major rally. The miners increasing their inflows to exchanges is another institutional level signal that's bearish, because these are the entities that understand Bitcoin's production economics better than anyone. When miners are selling rather than holding, it suggests they're either taking profits or need liquidity, neither of which is bullish for near-term price action.
Thanks, Lizzie and Steve, for those insights today. As we wrap up, remember that markets are dynamic, and today's analysis reflects current conditions that can change rapidly, especially with geopolitical developments unfolding. Whether you're trading equities, watching economic indicators, or navigating the crypto space, risk management remains paramount in this environment. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to The Morning Bell and join us tomorrow as we continue tracking these markets. I'm Robert, and we'll see you next time.